taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
All right, welcome to Total Money Management. Guess what, gentlemen? We are on episode 50.
Drum roll.
We haven't been kicked out of the studio yet.
Haven't been cancelled?
Not yet, but it's only early.
I can't believe it. And if you've been around for the long haul, which should be over a year now, thanks for sticking around. It's been a pleasure.
Well done.
Yeah, and we're looking forward to make the next 50. I think next week or the week before we've got a special on stocks versus property, which has been popular within the community. And we're hoping to make a few more masterclasses on stocks and property and ETFs as well. So,
yep.
Yeah, well done.
More content coming, folks.
100%. Oh, probably worth noting too, I think we touched on in the last podcast that we recently did a masterclass. But if anyone wants to check it out, you can still register and you'll get access to the recording.
Yeah, I'm going to pop it up on the website. It'll be up by the time this gets released. So
very good.
There you go.
Oh, gosh.
What's going on this week?
That's impressive if I do say so myself.
We're getting there.
Right, get a chart up. Come on. We've got to get visuals. Get visuals.
We're going to be talking about some stuff we haven't before. So declining living standards.
Are you being facetious there, Tom?
Maybe. Tariffs, ETFs, falling house prices, debt levels, and capital cycles.
Bit early to be a smartass. So you make 50 editions with someone, suddenly they're all cocky.
We're friends now.
They're throwing off at the old fella. Righto, let's go, gents.
All right.
What are we on?
Well, the big issue, right? It's been a pretty quiet week in terms of headlines. Markets are continuing to recover from the volatility. We've now had 10 straight green days, which we touched on last time.
Is that a first?
No,
but it's rare.
It's really rare. If my memory serves me correctly, I do remember the 12 straight down days. That was at the start of 2009, believe it or not. And that was when, of course, that was when, the Aussie market returned, I think, 25% in 2009. March 9th was the low, and then it went up from there.
So are you saying now that the bull market's just started?
Well, time frames, Tommy, time frames. I think we'll probably have a good run into the end of the year. I think the end of the year there's a fair bit of momentum. US election.
Santa rally.
Might
have started already.
Feds, Jesus.
But we haven't really had the sell in May and go away effect this year.
Oh, well, yeah.
The
seasonality's still fairly on track, I think. It's been a pretty lackluster June, July, August, and we haven't finished yet. There's still September. September, October can be a bit rocky, and it really picks up in November. November, December, January are the three best months, and that's when you get in there and be a bit of a pig in well one, and you can do quite well. Now, that doesn't mean that every year you get a really great performance, but generally, right?
We're talking about probabilities, right?
Yeah. Statistically, you look at it and go, hey, listen, December when it goes well, it goes up 1.5% or whatever, right? So that's where you sort of look at it. But again, this is the thing, right? We say, oh, look at this, 10 up days. Whoa, man, that's fantastic. And then you go, how'd it go to the 10 days before? Oh, I went down like terrible. Yeah. It got smashed over 2 days. It's like, oh, okay, so are we in front? It's like, no, we're just back to where we were 2 weeks ago.
Yeah, haven't really gone anywhere, but if you've used your strategy, like your well one strategy properly, then you've done okay.
Happy days. But yes, for the long-term investor, they sort of go, oh, that's interesting, but it doesn't, we're not going to be sitting here in 5 years going, oh, remember, that 10 straight up days.
Yeah. Overseas, Kamala's getting ahead of the old Donald a bit, isn't
Go, girl.
It seems to be that the polls are kind of turning towards her now.
Yeah, absolutely. Donald looks like he's lost it a bit.
Yeah, he's struggling. But what does that mean? It's good for us if Kamala. It doesn't really make a difference, really.
Well, yes, it does, and that the reason why is because Trump is an outlier, and because America is the global leader, you've got to be a bit careful of who's in charge in America. And as I said, when they say, righto, we've had enough of this globalisation bullshit, we're going back to doing it ourselves, everybody goes, whoa, hang on, what does that mean for us? Well, that means you built too many cars, brother. That's where countries are saying, oh, hang on, we really need to get a hold of what's going on here, because the Americans have decided they're going to build semiconductors. And that's why I say to people, there's a lot of disdain for America and a lot of contempt. But when the Americans say they're going to do something, they don't fool around, right? And when they put their mind to it and say, we're going to do this, that means they're going to do it. Now, it might take 5 or 10 years and it might be messy and it might be volatile, but they get it done.
They'll figure it out.
Absolutely. Absolutely. That's what makes them rich, right? They stumble and fall and they get up and they create more jobs and they have more debt and then they blow up and then they do it all over again, right? Whereas Europe, if you have a look at Europe since the GFC, it's been miserable, right? Look at Australia. Our market's hardly gone anywhere. Look at the Americans. It's gone up like 450%.
Yeah, well,
they're all rolling in dough.
Well, it's the money flow. All the dosh is in America at the minute.
Yeah. But they're not. They've got that dynamism, Jacob, where with bankruptcy, it's just like, I went bankrupt. Cool, start again. That's all they do. There's no stigma attached to it. You know, like here, if you go bankrupt, it's like, oh man, that's terrible.
You're a failure.
Yeah. Whereas in America, it's like, oh, I went bankrupt 5 times and then I hit it big and made billions. It's like, cool, that's the American dream. Right? That's what they all go for. They all go, that's fantastic. Whereas we sort of look at it and say, oh, God, man, what, you would have given up after the third time.
Right.
They don't. They just try again. Right? And that's the way it's designed. There's some really harsh elements to it, but, you know, all the really, really, really rich people are in America.
Yeah.
You know, so.
What's this chart about? Real gross national income against living standards.
Speaking of depression, here's our gross national income falling away to minus 1.9.
Yeah, but I mean, in this, we talk about reverting to the mean a fair bit.
Yeah.
And this is low and below the mean.
Yep.
So should we see a rise?
Well, that's why my argument is that Australia might probably do better over the next 10 years because we're getting more into industry policy, right? So the government is, as we said in the new normal, one of the parts of the new normal is we're not going to leave things to the free market. Governments are back in the business of saying, no, Tom, you're not borrowing $5 million to buy property, but you can borrow $5 million if you want to build missile parts like we talked about last week.
On our terms.
Yes. Yeah. We'll give you the $5 million. Here's what you're going to do, right?
Yeah.
Which is what Biden is doing in the US. Biden is saying, we'll give you money for the Inflation Reduction Act and the CHIPS Act. You're going to have a unionised workforce. You know, this is what you're going to do, blah, blah, blah. And that hasn't happened for 30 or 40 years.
Yeah.
Right?
So the next 10 might be a little bit of a change. But it's not going to change unless wages rise.
Well, if you look at the blue line on that chart, the real net national disposable income was obviously all-time high at the peak of COVID. Like
which was artificial.
100%. Everyone was getting, random payouts.
Yep. Look at it from 2017.
100%. But
it's been a day.
I guess what I'm saying is, like, in the last 2 episodes, we've shown a few charts, and anyone who follows the week that was will have seen, national household debt, outrageous.
Yep.
Cost of living, outrageous. We are obviously below the mean, or the average for disposable income.
Yep.
How do you get that back?
Wages. You do there's 2 ways to do it, right? Productivity, right? By saying, all right, I'm going to be more productive. Now, generally, just broadly, that means I'm going to get a robot and I'm going to sack Tom. Right? Tom costs me 50 grand a year. I'm going to get a robot, cost me 30. There's an extra 20 grand. And Tom used to make 10 sandwiches a day and my robot makes 45. Huge increase in productivity, right? And that's what it's all about, right? But generally you had to say, well, that's okay because now Tom's going to go and do another job, right? But what we've had in Australia is because we've had this huge debt burden at a household level, not the business level, the household debt has been generally going to buying unproductive mortgages.
Yeah, new cars, all that stuff, right?
Right. So that's why you've got falling living standards because wages are not increasing. And wages are not increasing. And again, this goes back to what we talked about last week with this this mercantilist sort of economic theory, right? When you give away, if we used to make cars and then we go, you know what, we're not going to make cars, we'll send them to China, right? We'll get China to make them. Now you've got 500, you've got 5,000 people in Geelong who are out of a job. So you've got two choices. You can either say, they'll just be unemployed, or the only alternative is to say, all right, we got to lend them money. And that's what we did. As we reduced our manufacturing capacity, we kept borrowing more and more money. And that's why I said last week, people, you shouldn't blame people because they're just trying to reach their financial goals. And in the old days, you did that by saying, oh, well, you worked at the factory and you retired at 65 and you got on the pension and you looked after your grandkids. But see, guys of your generation, you're not going to see that. Right? Because when you grew up and you started working, there was none of that like, oh, well, Tom, you've secured a job at wherever and you'll be there for 45 years and you'll knock out a couple of kids because you'll be foreman by the time you finish and, your wife will look after the kids and you'll have a happy life down at Sandgate, watching the waves roll in. When that's taken away, what people do is say, well, hell, I've got to take a risk to get my financial goals. Mm. Right, and that's what people do. Well, how do you do that? Well, you leverage up.
Yeah, and people are becoming a lot more savvy around investing now, and it's the whole financial independence, retire early generation as well. So,
yeah, but my argument, Jacob, is that's a bull market thing.
Mm. Yeah, it's timing, like when it makes sense.
I think again, you get a lot of these fire stuff. I'm not being critical. All I'm saying is it's a signal of the times. Financial independence, retire early. Okay, so you hit the workforce at 20, right? Now, if you fire at 35 or 40, you've got 20 years. So you've got 20 years to sort of, get rich enough to retire early and do whatever you want. That, I can tell you, is not a long space of time.
No, yeah.
Right? It's quite short. And what I'm saying is that means you really got to get in there and speculate a fair bit.
Yeah.
Right? You're not sitting there going, you know what, I'll just plonk an extra $50 a week into superannuation and, I'll be knocking off at 45. No, you're going, listen, I'm just going to go and borrow and, I'm going to be the, 10 investment properties in, 5 years or whatever.
Yeah, yeah.
Which is hard to do with the current valuations.
Well, it gets harder, Tom. But my point being, when you've got that mentality because you're in a bull market, right? If you look at it around Bitcoin, right? Well, no one's talking about, I'm going to buy some Bitcoin and put it away for 20 years, right? All the talk is, dude, it's going to be 100,000 by next week. You get the same thing in stocks. Right, you get the same thing in property. And what I'm saying is when you see that, what you are looking at is a bull market psychology. Hey, you're going to get in there and get rich. Okay, what do you do? Well, you just buy property, right? Okay. That's not the way it works over the long term.
Yeah.
Right? No one in my age talked about financial independence, retire early. Right? We talked about getting a good job, settling down, dropping dead at 75 and leaving the money in the house to the kids.
Yeah. Something that keeps coming up on the socials, and I'm digressing a bit, is precious metals, gold, silver, platinum, because that seems to be the theme now. Everyone needs to pile into gold and silver, and it looks like it's going to have a really nice next 5 to 10 years.
Well, historically, right, when there's uncertainty and volatility, people turn to stores of value.
Yeah,
and
yeah.
That's
it's
considered
precious metals.
Yeah.
When you don't trust government, and this is what all the boys bang on about cryptocurrencies, and in the old days they used to go to gold, right? The argument was, the government is debasing the currency, right? Inflation, right? So what they're saying is, you got to find a store of value that doesn't lose its relative value. Now the argument is from the gold bugs, you buy gold, right? So that's the argument. Now, underlying that is the US government spends too much money and they're all corrupt and, they've all got this grand plan and it's all the deep state and all this sort of bullshit, right? But that's what sells subscriptions to gold magazines and people like Peter Schiff or Ron Paul who talk about going back to the gold standard and all that sort of stuff. And again, that's what you see when you start to get inflation and people start to get under stress. right? So what do? Mate, you buy, precious metals. But if you look at it from a practical point of view, you'd be better off investing in baked beans, right? If you think the world's going to come to an end, well, mate, that's really good. You've got a gold bar, but what are you going to do? Carve a bit off every time you want to go to the shops? It's really stupid, but it's a good investment, right? Gold has been cheap for a while. Well, now it's all-time highs. But again, if you look at the cycles, I think it was 2 years ago, gold, silver, platinum, palladium, the precious metals, were at all-time lows.
Yeah.
Now, there's ETFs on the Australian market, and we talked about one of them in the masterclass, but they've done really super well. But my point is, again, like we talked about last week, you've got to know why they've done well. And please don't think it's because, the government's going to fall. It's like, that's not the way it happens, buddy. They were talking about the government falling in 1925. And they were talking about the government falling in 1815, right? And lo and behold, they're still there, right? It's just these themes where what you see in a lot of markets, Tom, is people who have an ideology and they adhere to that ideology. So that's why at the moment there's a lot of people going, US is in recession. Bullshit, it's in recession. You got the American government spending like 3 or 4% of GDP. It's an enormous amount of money in deficits, and people going, there's a recession. If you look at, retail consumer figures in flat whites, it's like, yeah, right, okay, good for you. But the wages are high. They've got an investment boom.
They're having economic growth.
Yeah, but people, you see, what they're saying is, but once the government spends too much money, you get it. They're going to have to raise taxes or do something to fund the deficit. Well, no, they're not. But anyway, that's another argument. But my point being, when you get an ideology-based thing, so there was a guy who wrote on X during the week, which was really good. He said, "Look, Peter Zehan, I think it was saying, if you listen to Donald Trump, the economy's shit, the nation's going to hell in a handbasket, America's terrible. Listen to Kamala Harris, and it's like, everything's really good, we're going to continue on, we got great jobs, blah, blah, blah. The Trump people will tell you the economy's terrible.
Yeah.
The Harris people will tell you the economy's really good. The trick is, like in investing, is to say, hang on, let's look at this as objectively as possible, right? And if you're a Trump supporter, you ain't going to do that. If you're a Kamala Harris supporter, you ain't going to do that. But the really clever investors in the US hedge funds, the big guys, they can support either party, but they don't let that interfere with the way they're investing.
Yeah.
Right?
Look at the numbers objectively.
Yeah, absolutely.
What do you reckon, bullion? Or if you were to invest in gold, would you go buy some gold bars and bury it in your backyard, or would you buy ETFs?
Why would I buy bullion?
I don't know.
I know, but
all the gold bugs go on about you the physical.
You can the idea with a lot of this stuff is, particularly with ETFs, is buy an ETF, and then if you want, buy a junior gold miner, right? Or buy a big mining company, Newcrest, right? Not advice. Or you can buy Northern Star, right? Or you can say, no, that's too hard. I'll just buy the gold ETF, which is GOLD, right? You can do a little bit of both, or you can be all in one or all in the other. It depends what suits you as an investor, and that's why I say, we talk about personalities. Because if I'm there going, Tom, you got to be in these big companies, blah blah, and you're going, gee, Steve, that doesn't really excite me.
That sounds boring.
That's your personality kicking in, right? And that's why, again, I say you've got to understand yourself, because if you don't, if I'm saying, Tom, you should be doing X, you feel a bit weird because it's like, but Steve, I don't want to do that. But I keep telling you to do it this way, right? So again, it's the same with the ideology stuff. No, Tom, this is how it works. It's all going to hell in a handbasket and it's all really awful. And you're going, oh, my God. And you're thinking, oh, I've got a really good job and things are going really well for me. Oh, apparently things are going to hell in a handbasket. Oh, all right. That's not you, right? Yeah. That's that person being ideological. So that's why, as I said, you got to figure that out and say, I'm a well 3 guy. I'm a well 1 guy. In fact, I just love investing. I want to do wells 1, 2 and 3. Right? It depends what you want to do.
Yeah.
Fair enough.
It's interesting. Yeah, you see it all over socials.
Yeah, like a lot of people are interested in, should I be buying gold? Hopefully that that helps.
We might do another
Hopefully that
masterclass.
Well, it should be part of your portfolio.
Yeah.
The question is, should it be 2%, 20%, 50%, or what?
Yeah.
Well, yeah, that's part of the well 3.
Yeah.
Look, Tuesday, we won't go on it too much because we did touch on it last episode, but it's really just, there's an article here pointing out that half of China's car dealerships operated at a loss.
Yep.
And mainly due to the price war in the auto industry at the moment. 50.8%, to be specific, reported losses. Only 35% were profitable.
Yep.
So
That can't last, right?
otherwise they close.
Well,
They have to close the doors.
Yeah, exactly. But then, you see what I mean? Then you're going, what do we do with all these car makers? What do we do? And for the Communist Party, it's like, what do we do with all these workers?
Yeah.
Because if people start getting pissed off, it's like, hello, we better give these people a job. Nobody wants to hire them. Why not? Oh, because we're all loaded up with debt and we're not really making much money and America doesn't want my products anymore. It's like,
Mm-hmm. Well, this is an interesting chart. When I saw this, I almost fell off my chair. These are the tariffs America have put on China. And again, go jump on, look at the week that was if you want to see these charts. Anyone can sign up, doesn't cost you anything. But electric vehicles have gone from 25% in 2018 to 100% in 2024.
They've gone up by 100%. Is that
That's how I'm understanding it.
Yeah.
Semiconductors have gone from 25% in 2018 to 50%. Solar, 25 to 50. And then you go down the list, like things like even syringes and needles, gone from 0 to 50% today.
Yeah.
So across the board, it's been brutal.
that's
What is it?
deglobalization in motion there.
Yeah. And it applies to over 300 billion of Chinese imports. So that's significant.
Yeah. Well, that's why I say we're in a new normal,
Trade war.
right? We're not in that position now where we go, we'll just take all of that stuff that China's got. It's like, nah, we're going to start doing it ourselves.
But if there's still, or maybe I'll play devil's advocate, if there's still consumer demand and consumers are still willing to pay an extra 50% or whatever for a BYD vehicle, America will continue to import. No?
Well,
We are seeing BYD everywhere.
In Australia.
Yeah, but we're in
we don't
Australia.
have tariffs.
you see, this again. Now go back
But
to
how
that.
long till the US goes, hang on, like, if you want us to be on your team, I want you to start doing this as well.
What do you mean by that?
Well, we just made a comment then about we don't have the same tariffs, so there's plenty of BYD.
Australia?
Yes.
Yeah.
How long till the US wants us to play that game as well?
Well, they'll tell us. We'll then go to Thailand. Or this is why I say, if you go back to that chart, Tom, look at the bottom line there, right? Look at the bottom line there, right? Ship to store cranes from 0 to 25%. Now, you would say to yourself, what the hell is that? Those cranes have all the data about what comes in to America. So if China has provided 80%, I think I said a few months ago, 80% of the cranes in ports are Chinese made. China has access to all that data. Oh, look at the Americans. They're shifting bombs out of San Francisco into Texas. They're moving them from California over to the west side or the east side. Well, that's like, hello, this is what we're doing. Well, you don't want to give that to your enemy. And that's the same thing with electric vehicles. And we talked about this a couple of weeks ago. This is the difference than it was 50 years ago when we imported Toyota Corollas. Because once the car was sold in America, they could drive it anywhere. And if Toyota said, hey, listen, where's Tom's car? They go, mate, we don't know. Now they can just go, oh, look, Tom's currently in San Francisco at Walmart, Oh, look at he's bought all this and he's done all that, right? The data has become the new oil because, as I said, with the data they can then sell Tom more products because they look at everything you purchase and they run it through algorithms and say, Tom's doing X, Y, Z, blah, blah, blah. They know your income. They know where you live. So they map your whole life. They look at, they connect it to Facebook, Instagram, everything, and then go, okay, now we know what Tom's doing and now we know what we've got to sell him. Right, it's a little bit, and then throw AI in the mix.
It is nuts. Have you seen the documentary, The Great Hack? the Cambridge Analytica stuff?
No,
and
no.
how they use
Oh,
all those
yes,
data
yes.
points
Yeah,
to
yeah.
change. It's just nuts.
But that's why I'm saying when people are saying quite legitimately at the moment, oh, there's not that much changed in trade. And it's like, yeah, I know, but we've only been at this for 18 months. You look at this stuff saying, well, this is obviously not us going, you know what, we're all going to be friends again, right? I mean, as I said, this week Australia said we're going to build missiles. Jesus. You know what I mean? Australia's going to start building missiles. What the hell's going on there? Well, we need it to keep the Chinese at bay.
And we've got all the bits here to do it onshore.
Well, yeah, but the technology will come from America.
Yeah.
Right, there's some capacity here as well, and this is why I'm saying what you're seeing now is the trade relationship is following the political relationship. And so in 5 years, Australia is going to have to, we've already hitched our wagon to the US, right? And this has always been Australia's great problem of saying, hang on, we sell everything to the Chinese, coal and iron ore and agriculture, but they're going to be the enemy. And on the flip side, we're building missiles and submarines so we can spy on them. And if they do anything, we can kill them as much as they kill us, right? So you look at it and go, that seems really nutty. And it's like, it is. That's the way it works. Until we say no more BYD cars in Australia. Now you look at it and say, oh, Steve, that won't happen. That's the way it works. That's what they're putting the tariffs on for, right? They'll just keep ratcheting it up until the demand for Chinese, you can buy a car from Thailand for 10 grand or you can buy the BYD from China for 45. And by the way, it'll be a 6-month wait while we check it out, strip it, put new computer bits in it so they can't track the data. That's the way it's going to work.
So that's the US at the minute. Europe will probably follow suit pretty soon.
Well, they've already said they're going to start raising it more and more.
Yeah. And that'll force consumer demand into other areas.
Yeah.
Into other cars.
You'd think about it, Jake. Really, when it all boils down to it, you want to get from point A to point B. Right? That's it.
And if you've got enough money to get there in style, you'll buy a nice Range Rover or Bentley or something.
Something anyway.
It doesn't matter. Yeah.
but after you've done the wealth effect on your third property, which is now $14.5 million a year, and the rent's, $2 million. But the issue there is that people, you get a lot of like, oh man, I can't buy this or I can't buy that anymore. But, does it turn your world upside down if you've got to choose from 6 cars rather than 36? Not really. Oh no, I really want an EV. Really? Why? Because everyone else has got one? It's like, oh, okay. Here's a hybrid. Or, here's an ICE vehicle and it's 10 grand. And I think we said a couple of weeks ago, like this bullshit about caring for the environment. What? When all these blokes are driving around in gas-guzzling V8 SUVs? Oh, please stop it. You know what I mean? Like it's
the whole net zero argument.
Well, yeah, but it's I see it with my own kids. Oh, we learn about the environment bar. Good, turn off the bloody light. Right, turn off the heater. Turn off the air conditioner. Oh my God, I'm not doing that. It's so hot today. It's like, right, okay, so much for the environment. Right?
It only matters when it's outward looking.
Well, it's the reason why we need regulations to say, if you want to save the environment, fair enough, here's what it's going to cost you. And every election I see this, the environment's a big concern. Okay, the Greens are still getting like 3% of the vote or something.
Yeah. Well, you do what you do in South Africa and they just turn off the gas for a couple hours a day. That's because they're running out, but...
Yeah.
All right.
But your point is a good one, which is things change where you can't conceive it changing. Do you know what I mean? Like, you think back even 5 years or 10 years, right? And if you'd have said, listen, Russia's going to invade Ukraine, we're going to have a pandemic, there's going to be this, you'd have most likely gone, I don't see that. Everything's rolling along, we're all friends, Next minute, here we are. And once you get on that trend of increasing tariffs, stuff like that, that's where you say it's really hard to turn around because the elephant in the room, the two elephants, America and China, have decided to go at each other, right? And it's not over economics because they're doing all right and the Americans are doing all right. It's over politics. right? And it's over who runs the global show. So that's why I say economists are still sitting there talking about, free trade and how this and how that'd be good. And it's like, guys, sorry, you're on the wrong ship. We're talking about what's politically feasible now.
Yeah.
Awesome.
Well, not awesome for New Zealand in the next slide.
Yeah, is this... So it's fallen 25% in some...
33 months.
This is Wellington, hey?
Well,
Auckland and
there's
Wellington.
Auckland there, there's Wellington,
And the Nationals.
Well, we're basically saying, well, it's not Australia, right?
Not yet.
But they're just over the pond. And this is a classic example.
Most of them are over here.
They were about probably 5 or 10 years ahead of us, all going through this property bubble, property boom. It's only ever going to go up. And now, look,
Yep.
we're 25, 30%.
Interesting. I didn't know it was that much.
It just eventually turns. Right? That's look, as I said to people, I don't hate property. I don't know when, but they always turn down because you can't imagine if property goes up again in another 10 years like it has, Sydney's average house price will be $3 million. Okay, so if you think about that, you say, okay, what would be the average wage needed to cover that? Which I think we talked about. Well, it's in the next chart, kind of. We did talk about it in the wages. That means wages have to go up 7 or 8% per year to keep up. Well, wages are going up about 3.
Yeah, and the taxes go up the more you get paid too. So
Yeah.
it's the...
Bracket creep and stuff.
Yeah.
So
it actually has to probably raise way more than that. It's not...
that's why I'm saying you have to sit down and do the numbers and project them out and say, okay, can I see that happening? Probably not. But because we've been in a bull market, people say, I can't see the downside. Right? They can only see the upside because there's only been upside. But as I've said before, there are still people who bought property at the peak in certain places and have lost money. Now, it's not, it's not everybody, but what I'm saying is there are individuals out there who have lost money.
Well, by the looks of this, there's a few in New Zealand that are hanging on and white-knuckling.
Well, this is why, it could get worse over there.
30% discounts, all right, at the minute. You want to buy a house?
Which is actually timely. If we click onto the next one and we look at Friday's chart, I know we touched on the percentage of household debt to disposable income
This is
last
outrageous.
week. But the fact that we are 2 times the US, just about.
So even in 2008,
frightening.
before the GFC, 2007, 2008, we're miles ahead of that.
Yeah.
It's terrifying.
Well, that was the first start of the property boom. And remember, our CAPE ratio was 31. It was the highest it's ever been in 2007. So here we are 17 years later, and we're only just breaching what we were back in 2007.
It's terrifying.
That's gross.
And we're miles ahead. And the amount of debt, and we've mentioned this a few times, the amount of residential debt on Commonwealth Bank's books is still over 60%.
Yeah. And the share price has gone absolutely gangbusters.
Yeah.
Well, you can see why, because they've got a huge mortgage book.
Yeah.
Right. But the interesting part is what you should be saying is how do we get that household debt lower?
But there's not many people defaulting.
But there never is, Tom, at the top. Right. And again, defaults happen later on. We're starting to run down the offset accounts.
Yeah.
Like all of those things you got to look at.
Well, we've seen that the offset accounts are declining quite rapidly. Savings are declining quite rapidly.
Yeah, and people will be going, oh, cool, this rate cut might...
It might save me a bit.
Yeah.
Look, it might. It
build
might
that
go on
up.
for another 5 or 10 years, right? Like, it could go on indefinitely. Who knows?
It can't go on indefinitely, but it goes on longer than you
knows?
think.
Yeah.
Steve knows that it can't.
Steve knows.
But it's logic, Tom. That's what I'm saying. When you have exponential growth, it gets to a point where you say 5%, and this is what we talk about and what I will highlight in stocks versus property. Real estate prices in 1500 in Amsterdam, right, were $10, right? On the scale, they were about 100. Now, even if you said they're going to compound at 2% per year, you've got 500 years of compounding at 2%. So that means now Amsterdam property should be like, $25 million. Well, it's not. Why isn't it? Because it's gone up and gone down and gone up and gone down and gone up and gone down. So at some points it had doubled to 200, then it's collapsed back to 50%. Then it's gone up 30%, then it's gone down 30%. So in other words, over the long term, you see the long-term average in property is about 1 or 2%. And that makes complete sense because you can't have it growing at 8% per year because you leverage up, and that means everyone would be borrowing, and that means you'd need wages at 8% per year to continue the
growth,
the scale. And all we've done in Australia, as you see there, is we've gone from 110% of household disposable income to 185. Right? And that's what I'm saying. All people are doing is building more and more debt, which is driving the house prices higher as everybody jumps in to bid up prices.
Mm-hmm.
And you look at it and say, why would I pay more for a property that you've done absolutely nothing with? Why would I pay more than the inflation rate? So if you bought it for 500,000 and inflation's, like 2% or whatever it is, right? Why would I come along and say, I'll give you 750? Now, you can argue and say, yeah, but Steve, the rent is X, and you get a good yield. And you go, okay, what's the yield? The yield's 2%. Okay, well, I can get 5 in a cash deposit. Why am I getting 2 in a property? But the property's going to be worth $1 million in 5 years. Okay, it might well be. But at some point, it might go back to being worth what its real value is, which might be 650.
Yeah. Whereas someone might come along and go, well, I need somewhere to raise a family. So,
yes, but again...
But as an investment.
Yes.
Yeah.
But that's the distinction we make between a home and an investment, right? But again, my point being that, as I say, there are people who have bought properties and have lost money the same way that people buy stocks and lose money. It depends on what the value is in relation to the price.
It's totally different decision set buying a house for a home to raise a family and buying 3 investment properties to turn a profit.
And there's a difference, which we'll talk about, between stocks and property.
Yeah.
Right? Stocks are productive. If you've got a company and you said, Steve, I'm going to borrow some money, you're not going to borrow it to speculate. You're going to borrow it to make more profit.
Yes.
But if I buy a property as an investment, then it's not productive, because what productivity means is doing more with less. Well, you can't just keep shoving people into the house, right? That's a fundamental difference that people don't see when you look at stocks versus property as investment. That's why Warren Buffett doesn't have a portfolio of 5,000 properties.
Yeah, true. You'd think if anyone
knows, he's got a little bit of an idea.
That's actually a very good point.
That is a great
I'd love to know how many it does own. This is my favourite chart of today's session. Sector price to earnings ratios over the last year. And again, you might have to blow it up or go and download the week that was. But this is showing energy, which is really cheap. It's currently about 13, just a pip over 13. We've got consumer staples, which are up there. So utilities, which have had a bit of a big spike over the last year. So these are all things that we've been talking about for 12 months or so now. And it's just showing what are the really expensive sectors versus the places you might want to go and have a look.
Yeah, energy and financials are probably fairly good.
But look at real estate, 45, 46.
Yeah, and look at technologies, about 40 odd.
Yeah, and for the people that don't know what the average is, obviously each sector has a slightly different average, but you're looking at 15 to 19 really is where things...
Yeah, 15's about 15, 17, 19.
Yeah.
So that's why you can see the Cape at 35.
Yeah. Well, technology's smashed it out the park. Real estate's pushed it right up there.
How many more 8-foot people are going to walk into the cafe?
That's exactly right. I'd rather be in energy where we're not going to wake up tomorrow and go, oh, we don't need oil anymore. Right? But you can wake up tomorrow and go, you know what? I'm just going to skip the next iPhone.
Yeah, that's true.
I'm not going to skip the next iPhone because it looks really good.
You just bought a nice new MacBook, mate.
I did. As soon as I get the password, I'll be into it.
Bought it 2 days ago. Already forgot the password.
Yeah, well, Jesus, 61. I just want to open up the computer and bloody well get it to work.
Short story. All right. Another Buffett one. Let's finish up on this one. Do we have a chart of the week as well?
We do.
We'd have a slight chow.
All right, cool.
Do you want to do chow?
Do chow first. All right.
No, sorry, my apologies. No, do Warren Buffett, yeah, because we're talking about energy still. I'm just keeping you on your knees.
On my knees?
What do you keep them on? Toes.
I'm not used to being on my knees.
Right. Live on your feet, die on your knees. What is it? Live on your feet. No, live on your knees or die on your feet. Oh, one of those. Anyway, edit that shit out, Dan. Right, get on with it.
Not a recommendation. Buffett follows the cash and the capital cycle. So when inflation rises, it means higher prices, which we've been talking about for 40 minutes. So let's say a company discovers oil, they need to buy or lease an oil rig to get it out the ground. With rising prices, the oil rig is more expensive than it was, let's say, 5 years ago. Now imagine a competitor that already has a functioning oil well, their own rig, and so they've got an advantage, a competitive advantage, because they don't need to pay a high price. And they profit from the margin off of it. So,
yep. This is the stuff about the new era.
Yeah,
right? Hard assets are going to become sexy again, and the reason why is because if you've got an existing oil well, you have already paid that off. If you say I've discovered oil, and they go, you can buy a rig and it's $4 million, right?
400 million.
Yep. The guy over the road who said, I bought mine for 50 million 20 years ago and it's still pumping oil. I've got no costs on it. So think about Coca-Cola, right? They got all those machines and they just keep pumping out Coke and they've all paid. Tobacco machines, right? They just keep making the same shape tobacco and it's just the same for the last 50 to 60 years. All those machines have been paid off. Warren Buffett loves cash. And one way that you get cash is by not having a lot of assets or needing to do a lot of research and development or capital expenditure. Buffett hates that stuff. That's why he hates technology, right? Because there's a huge amount of money in R&D and changes and CapEx. Buffett loves oil wells because it just sits there and just pumps that bloody goo out of the ground. They get it in cash and they give it to the shareholders, right? And it's probably worth just running through that caption there.
The quote, I think I've got it up here.
Yeah.
All right. One time I was talking to Charlie Munger and he mentioned that he would love to have an investment in Exxon if he could get a commitment from the management that would do no more CapEx. And they would simply run all of the oil fields with the cash flows going into the shareholders. So he had calculated that it would be a tremendous investment. And of course, oil companies don't think that way. But Oxy thinks that way. If you study,
that's Occidental Petroleum.
Yeah, I was going to say.
I was like, get on the Oxy.
Yeah, let's just be clear.
If you study Occidental Petroleum, what you'll find is that they don't really have an exploration going on. Oxy basically has no speculative drilling going on. So in effect, it looks like a CD, which is
a certificate of deposit, which is basically what we call a term deposit.
So they're clipping coupons.
Right.
So what Oxy's doing is they're having a huge gusher of cash flows coming out, and that huge gusher of cash flows is only going back to buybacks and dividends. It's all being pumped into the shareholders, and Buffett loves that. So he looks at Oxy as a US Treasury on steroids.
Yep. So remember Buffett said, I want a stock with bond-like qualities. So Buffett is, what do you get with a bond? Well, you get a regular yield of, say, 6 or whatever. What Buffett is saying is, I want to invest in a company that pays me on average a 6% dividend every year, right? So how do I do that? Well, I buy a company that doesn't have a lot of capital expenditure. Oh, okay, well, that's a good start.
Because that's risk.
Well, no, it's not risk. Well, it's partly risk in terms of competitive advantage. Right. So this is the problem with technology. You've got to keep changing it. You've got to keep spending money to keep up. Whereas Buffett says, no, mate, just keep pumping that oil out of the ground. Right. You don't need to update the rig or any of that stuff.
The costs are low. Yeah.
The costs are low because you've paid off the machines.
Yeah.
Right.
Absolutely.
If I said to you, every 5 years you've got to get rid of that $40 million oil rig and you've got to buy another one and the new one is $60 million, then you're saying, oh man, I got these costs and I got to add it on all the time.
But that's also a barrier to entry for competitors.
Well,
so,
for new
absolutely
suppliers.
Yep.
Yeah.
Absolutely.
So it's hard for your competition to get started.
Well, that's why the shale industry took off, because it was really cheap to start with. And but with my point there, what Buffett is saying is we're moving into, like we've talked about with the new normal, we're moving into a period of high inflation. What companies do you want in high inflation? You want companies that already have existing assets that generate a cash flow, so you don't have to continue to buy new oil rigs or new software or do research and development, right? That's why Buffett goes for the old boring stuff, right? Energy companies, oil companies, financials, right? Because it doesn't require a lot of money to run them, but they gush cash. Mm-hmm. And if you can get something like that, which is what Buffett's saying with Oxy, is when the oil price goes up, Oxy just gets flooded with all this cash, and Buffett says, give it to me. And then he invests it and compounds it at 20% like he's been doing. Right? So this is why he won't get into tech, because if there's no cash flow, Buffett says, I don't know what it's worth. Yeah. Whereas with oil, you can look at it, calculate it and say, okay, if oil's at this price, it'll be this. Right, okay, it's a good buy. Right? And that's why he went and bought the commodity aggregators in Japan. Right? Because he knows the world's changing and he's moving into hard assets are really becoming the place to be.
Did he do that recently?
No, he did that about 3 years or 4 years ago.
Okay.
But again, that's why I'm saying the new normal.
Yeah.
Right. He's subtly moving his portfolio to be positioned for the next 10 years. Because you've got to remember, the old bugger's 93. He's seen everything. Right. So he's seen these periods where he goes, I know what's going on here. Right. They recently sold out of BYD. Why? Because it's a Chinese company, and Warren looks at that and goes, I don't know about that.
Yeah, risk, tariffs, risk.
Exactly.
Yeah, income.
And Warren says, I don't do risk. Right? Yeah. So...
Look, we'll just quickly finish off on the chow because we've run over again. But basically, this one here is just indicating that stocks have outperformed all other asset classes if you look at the last 30 years. At the top of the leaderboard, we've got US shares at 10%. So if you'd invested $10,000, this chart starts in 1994 for whatever reason.
Bingo.
You'd be at 180,000 today.
Yeah.
And that's assuming that you've reinvested all your dividends, and that you've been a buy and hold investor.
Yep.
Right?
And look at it from 2009. Right?
Yep.
So from 94 to 2009, you didn't actually do that much.
Yeah.
Right? And that's, again, what I'm saying about all asset classes. So if you look at property, you can see these really big exponential growth rates for a decade or two, but then they plateau or they decline exactly the same way stocks do. Right? Look at that lovely blue line from 94 to 2000. It skyrockets from 10 to 50, but then it collapses from 50 back to about 25 in the next decade. So when you say, they've done 176,000 or 10% per annum over 30 years, it's like, yeah, but it went up 100, down 50, up 100 and down 50 again. So do you see what I mean? What I'm trying to point out there to people is this stuff about valuation and when you start is absolutely critical for your returns.
Well, yeah, that determines where you finish.
Absolutely. Yeah. And that's why I say if you want to buy property now, by all means, but you're buying it after a really seriously big, explosive bull market. Australia's got enormous household debt. If you want to buy it, then fine. But boy, oh boy.
Hold on.
It's not even a case of hold on, Jacob. In my mind, it's a case of saying, why do you want to buy it 13 times income?
Yeah, true.
If you do the yield in Sydney, it's miserable. Well, okay, why do you want to desperately get into a market to do that as an investor? But even with a home, as we were talking about up the copy shop, you do the rent figures, and I think we talked about this a couple of weeks ago, like the renters are going, oh man, this is terrible. It's like, dude, think of the landlord.
Yeah.
Like the landlord's going, you think it's terrible?
Yeah. You're paying $700 a week. The landlord's paying,
I'm paying $1,200.
Yeah.
So that's where that's why the starting point and those key principles we teach are really important, because you look at these charts and go, oh, man, like I would have done this, X, Y, Z. And so, not necessarily. And like you said there, Tom, well, why'd they pick 1994? I'll tell you why, because it's 30 years. Why not pick 27 years? Why not pick my frame, which is 19 years? Do you know what I mean? Like you've got to look at that starting point and say, what am I going to get from here? Not, this is what you see all the time in Australia, right? Oh, if you'd have invested in, bloody 1982 with $10,000, you'd be worth, 45 million. It's like, yeah, well, that's not the way it worked.
Yeah, because hindsight investing and cherry picking dates is the easiest way to, on
sell
paper,
stuff.
Yeah.
Make it look like you're a genius.
Yeah.
Well, make it look like it's a really safe investment and you'll be fine, and please pay me 1.5% every year for the next 30 years.
Yeah.
All right, let's wrap it up there, gents. A good one. Thank you so much, and we'll see you guys next week.
Okay,
Thank
see
you.
you, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.
Do you want to do chow?
Do chow first. All right.
No, sorry, my apologies. No, do Warren Buffett, yeah, because we're talking about energy still. I'm just keeping you on your knees. On
my knees.
What do you keep them on? Toes.
I'm not used to being on my knees.
Right. Live on your feet, die on your knees. What is it? Live on your feet. No, live on your knees or die on your feet. Oh, one of those. Anyway, edit that shit out, Dan. Right, get on with it.